Okay, good afternoon, everyone. This is Robert Blake here with Robert Blake from Parvis, here also with Darren Gazdag from Pier 4 during our brick by brick session. I just want to start off with a legal disclaimer. This is not intended to provide or should not be relied on for investment tax purposes, legal, accounting advice, etc. Nothing in the presentation shall be conducted or construed or recommended or offered to sell or solicited as an offer to buy any securities. So that said, we're here and we're going to learn a little bit about REITs today, and specifically Pier 4 REIT. As I mentioned, we have Darren Gazdag with us here today, and he's going to explain the details of Pier 4's REIT. So I'm going to turn that over to you, Darren.
Great. Well, thank you, Robert. Hello, and thank you for the opportunity. Just give me a second here and I'll get the presentation up. I hope you can see that.
Perfect.
Great. So again, thank you. I don't know about you, Robert, but certainly here at Pier 4, we couldn't be more excited about the prospects for 2025. We have now seen 6 consecutive rate cuts dating back to June of last year. Interest rates, cap rates, they are strongly correlated. So lower interest rates allow for cap rate compression, therefore property values increase, and that certainly gives a way for the potential for NAV growth. As a result, market sentiment without question is definitely up. The multifamily category really does continue to be Canadian real estate's most favored sector in terms of expected performance. And certainly here at Pier 4, we believe we are well positioned for continued growth. And I think most importantly, really to maximize investor returns. So with that, let's start. So the disclaimer, always the most exciting part of every presentation. So here it is. So today's presentation is broken down into 5 parts. Part 1, the market environment. Part 2, the fund. 3, the strategy. 4, the portfolio. What are you participating in? And then 5, the offering details. So I think you would agree. Immigration really is almost solely responsible for the largest annual population boom we've seen in Canada. Canada welcomed an additional almost 1.3 million people in 2023, and that reflects an increase of a little over 3% from the previous year, really marking the highest surge that we have seen since 1957. And as you can see from the graph, as population has dramatically increased, it certainly has caused inflation in rental prices and lower vacancy rates. So newcomers, well, they need housing. And Canada has long had a housing supply challenge, really for many reasons, some including zoning restrictions, lengthy permitting processes, a shortage of construction workers. The result is that new housing construction just has not kept up with population growth for many years. So with these housing supply challenges, the recent increase in newcomers has certainly added to the pressure on rent and housing prices, and this has affected inflation. Fortunately, inflation is trending down, always a positive. Just a factoid, it is estimated by 2068, 56.5 million people will call Canada home. That growing population will create demand for quality rental housing. And the good news, at Pier 4, we offer just that.
A staggering number.
It is. Just moving on to low vacancy rate. So you've heard it. I'm sure you've read all of the headlines over the last couple of years. Rent prices really have certainly soared in Canada. Supply has really struggled to keep up with demand, leading to the lowest national vacancy rate on record since CMHC really began tracking this data back in 1988. And although we did see rental supply, rise in most Canadian cities last year, it really was not enough to keep pace with increased demand pressures, really caused by population growth. So Canada still needs in excess of 3.5 million more new homes by 2030. And this is a figure that is provided by CMHC. So certainly in most major markets across the country, strong rental demand continued to outpace supply, resulting in tighter markets and certainly lower affordability. And as a result, the national vacancy rate for purpose-built rental apartments reached a new low, 1.5%. So I think certainly if the last few years have really shown us anything, it's that housing in Canada really is in very high demand. They're a real focal point of the Canadian sort of housing market, certainly over the last few years, it's been really this disparity, if you will, between the rise in home ownership costs relative to the growth of household incomes, a trend which certainly has definitely spilled over to affect renters as well. So as you can see, we've had or have seen almost a 30% increase in the average asking rent across really all property types, dating back to February 2021. And certainly if you sort of examine 2023 specifically, average family multi-rental rates grew a little over 9%, and that greatly exceeded annual wage growth of only 5%.
Wow.
So we have certainly seen rents accelerate, I would say sharply, across all property types. So $2,100 for rental apartments, that represents a 14% increase, a little over 5% for housing rental. And as a result, what we've seen over the last few years, and quite frankly, continue to see, is this exodus, if you will, from these major markets. And we are seeing interest in demand in these secondary markets really picking up. In fact, the fastest growth in Canada has certainly been happening in these secondary markets. And the good news, well, Pier 4 concentrates in secondary markets. So CMHC has certainly, or has been, continues to really warn of a slowdown in new rental construction, really as a result of unfavorable financing conditions, which are again going to continue to make new rental projects unfeasible. We are also anticipating that home prices are certainly going to rebound. We saw a little bit of that late last year, and as we sort of, roll into 2025, the anticipation is definitely on the positive side to see that. And I think as a result, more Canadians can really be expected to consider renting's enhanced value proposition. And I think a lot of that can really be attributed to really several key factors, including employment growth, demographic growth, certainly low affordability of home ownership, which, unquestionably has led to a higher tendency to rent. And, Canada's current purpose-built rental stock is really struggling to keep up with demand. And as a result, rental markets certainly will remain tight, particularly in those pricier areas of Canada. And I think the good news, certainly as we continue to see rate cuts, that certainly I think will represent some continued growth for investors as well as value certainly for residents, which is always a plus.
It's interesting, Darren, on that slide where the actual housing starts are decreasing in Ontario, that top line, it's actually going down. With all
Yes.
the population growth, you're actually seeing the starts dropping, which seems very counterintuitive, right?
Yeah, as I mentioned, Canada needs multiple millions of new homes just to keep up. And that really has been the challenge. And And that's why I think renting's, sort of enhanced value proposition has really taken hold over the last couple of years. So, Robert, we're just going to move on to the fund, if that's okay with you.
Yeah.
So here's a snapshot. This is taken as of the end of December of last year, 2024. So we have an implied cap rate of 5.61%, 31 properties. So the asterisk denotes that we are closing on a property literally today. So we're excited about that. As a result, 31 total properties, 892 total units. Our occupancy rate is very strong at a little north of 98%. Historically, we have paid a very attractive distribution of 8% compounded annually, paid out on a monthly basis. Our NAV, or our net asset value, today is $10.90. In fact, last year, 2024, was very strong. We went from 10.55 to 10.75 to now 10.90. So that's a 35-cent NAV increase. Certainly what everybody likes to see. So we're really excited about that. We have a targeted return strategy of 12 to 15%. So that's the distribution, 8%, plus the capital appreciation of the buildings themselves. That's how we get to that 12 to 15%. And then we've internalized our property management as well as most of our renovation team, and that part will certainly be complete in months.
Darren,
Yes.
that slide there, the 5.61 implied cap rate, is that number rising or is that number declining
Well,
at the
we
moment?
think, again, coming back to sort of my earlier comment, is that, with interest rates and cap rates, they are historically generally have been strongly correlated. So lower interest rates allow for cap rate compression, which in turn, therefore, allows the property values to increase, which then ultimately should have a positive effect on NAV growth. So we want to see an increasing NAV. I will maybe touch on that a little bit later as we sort of get
Sure.
onto a couple of other slides, because one of our real competitive advantages is our gap to market. And that can have tremendous benefit even if cap rates do rise, because that can sort of affect what you could potentially charge, i.e., for in place versus market rents. I hope that answered your question.
Yes. Thank you.
Just in terms of fund growth since inception, I just want to draw your attention to the bottom left-hand side. So inception was Q2 2020. Fast forward to the end of that year, total AUM was $6.7 million, 4 properties, 73 units. Fast forward to the end of 2021, AUM grew to 20 million, 8 properties, 144 units. And then certainly we have 2022. And as you can see, AUM grew to 65 million, 13 properties. And we had our first NAV increase from $10 to $10.30. We ended 2023 just north of 100 million. And again, we saw another NAV increase from $10.30 to $10.55. And then in terms of Q1 to Q3 of last year, AUM grew to 133 million, 23 total properties, 595 units, and again, another NAV increase from 1055 to 1075. And then we closed out last year at a little north of 150 million, 27 properties, 707 units. We also had another NAV increase. So today, the net asset value is $10.90. As mentioned, we are closing on a property today. So total of 31 properties, 892 units, and an AUM north of $190 plus million. So I think really by every metric, by every measurement, that is some pretty strong growth in a little less than 5 years, and something that we're certainly very, very proud of.
You're so close to that 200 million as well.
Yes, knocking on the door, as they say.
Yeah,
Just in
fantastic.
terms of investment growth, so Class A cash since inception would have returned 46.93%. Class A drip, so that's the 2% drip discount, which is available, would have returned 48.46%. And I think even more impressive, um, outside of obviously the number and the return, but here, $100,000 invested since inception at the end of December would have grown to $189,000 in change. But just look at that line, steady, consistent, somewhat predictable. Wouldn't you like to have that in your portfolio all the time?
Yeah, by comparison in public REITs, that goes up and down and up and down. So
A great comparison also, just keeping with that train of thought, is the Canadian private apartment index has never had a negative year in 43 years. And in fact, COVID, which was a real test, if you will, some of these public market REITs were down 30, 40 plus percent. And public REITs were certainly positive anywhere, depending upon which one, but anywhere from 3 to 6%. So talk about a way to somewhat mitigate some of the downward pressures of what's happening within the market environment. Just in terms of who's powering Pier 4, who's behind Pier 4, I think it's important to share that this is a family-owned multifamily REIT. As mentioned, it was established in Q2 2020. It really is built on 40 plus years of experience in the real estate industry, which includes includes ownership, I should say, property management, and I think really importantly as well, capital improvements. So prior to founding Pier 4, the Ashby family successfully operated a general contracting business since 1981, really serving some of Canada's largest landlords, and then later evolved into acquiring their own portfolio in the early 2000s. And certainly through these years of experience of being owner operators, the family decided to innovate and create Pier 4 with the idea of allowing investors to invest alongside them, as they acquired these buildings. So today, just to draw your attention to the right side of the page, we have two offices, our downtown office, and then one in Cambridge. And then certainly, as you can see, total employees, we're actually bigger than that now. We're about at 53 employees. And last year, we were recognized as one of Canada's fastest growing companies. So something that we're, very, very proud. We are
fantastic.
a full service asset management and property management company. And then collectively, we have, over 100 years of real estate experience. So moving on to independent trustees and directors, corporate governance, is very, very important to our business, really fundamental to our success. We take real great pride in selecting industry professionals to oversee the management and affairs of the fund. Independent members really do provide strong oversight for all of our standards and policies. They certainly do review our strategies, budgets, and property targets. And, thankfully, our stakeholders really do hold us to a very high standard to ensure that there is never any conflict of interest. So moving on to the strategy of the fund, integrity, accountability, customer-focused expertise. Our mission is very clear and simple. Deliver consistent returns for our investors while providing our tenants comfortable, secure, and affordable homes. So we offer true diversification, full transparency, and certainly all of the benefits of real estate investing without the difficulties of financing, tenant management, building maintenance, or project management.
It's a win-win for the tenants and win-win for the investors.
Absolutely. Moving on to, our strategy. So, certainly we as a company, we're committed to providing investors with a well-managed, diversified pool of multifamily assets We really are focused on acquiring value add real estate across Canada and optimizing profitability across the entire portfolio. So we are focused in on maximizing investor returns. How do we do that? Well, we look to create value to the portfolio really from the beginning. So we are committed to the triple R approach. So, realize, we look for properties with very strong return potential. We want to avoid market competition with off-market acquisitions. What revitalize, our goal is to elevate not just the look, but the intrinsic worth of every property. So we are certainly focused on, increasing revenue streams as well as reducing expenses. And then certainly from a return perspective, whether that be monthly distributions, special distributions, NAV growth, etc. Just to draw your attention to the right side of the page. So our historical average renovation cost, actually, it's gone up just a touch. It's $12,400. So I want to put this into some proper perspective. We have a three-tier institutional approach to renovations. We have bronze, gold, and then platinum. So bronze might be something very simple as, painting a unit and maybe adding some newer, fresher drapes, if you will. And then on the platinum end, that would be something certainly more fulsome. Hardwood flooring, kitchen cabinets or new kitchen cabinets, new countertops, stainless steel appliances. So that type of renovation would be roughly $20,000. Now, again, if you remember a few slides back, I mentioned that the Ashby family ran a very successful renovation company dating back to the early 80s. So they have very deep relationships. As a result of those relationships, we do buy in bulk. We buy at considerable discount. We do have a warehouse, and by no means am I suggesting it's like walking into Home Depot, but we do have skids of flooring or cabinetry. And the fact that we do it internally or we control that entire process, we are not outsourcing any of this. We are able to save considerably, control that entire process. And it is our goal when somebody moves out to have a unit renovated within 30 days and back up for rent. So as a result of all of that, since inception, we have been able to generate in excess of $30 million plus in fair market value gained. In fact, last year alone, we did 102, I believe it was, renovations, which generated a little over $14 million in fair market value. Gap to market. What is it? Why is it important? Well, it's the difference between in-place rents and market rents. So today, it's 54.48%. It's projected to grow to just shy of 59%. So why is it going to grow? Well, heading into Q4 of last year, it in fact was 59%. We turned over 100 units. As a result, that lowered the gap to market. 2025 has already been a busy year, and you'll see some of the reasons why in the next preceding slides. But since we acquired more buildings, that gap to market is now risen. So the gap to market is very important because that certainly does provide an opportunity for us on the turn to raise in-place rents to market rents, i.e. growth. So certainly in our case, a tremendous amount of growth will certainly come as a result of a very generous and without question, a key differentiator in our portfolio compared to our peer group, the gap to market.
Darren, question for you. That average historical renovation cost of $11,000-$12,000, is that at cost charged to the REIT, or is that is it marked up Or like, do you buy all, like for everything that you pay for, the REIT pays for, is it at cost?
Everything is cost. There's no markups. We don't outsource this. There's not a separate company, under the umbrella.
That's, I
We
guess, what I was
do,
getting at. Yes.
yeah,
Thank you.
we do this with really one goal in mind, and that is so it benefits ultimately the unit holder. If we were to outsource this, a $20,000 renovation, our cost, I'm guessing, I'm probably not far off, would probably be 40,000, maybe 50,000. So at the end of the day, because we control the entire process, we're buying at, deep discounts. We're able to do it within 30 days, so there's no quote unquote, overage. That's how we've been able to achieve, I think a very strong sort of historical average, if you will. And again, as I mentioned, there is a three-tier process, but nevertheless, across the entire portfolio since inception, almost 5 years, $12,400. I hope that answers your question, Robert.
It does. Thank you.
Um, just moving on to a couple of value add slides. So this particular building is in Kitchener on Onward Avenue. So here we spent $450,000. So what did we spend that money on? Well, we did 14 suite renovations. We installed security cameras. We put in new entrance doors, corridor renovations, throughout the entire building. Laundry room installation and renovation, installed intercoms, and as a result, we were able to raise rents from $920 to $1,259. And best of all, 70% of the existing units are still under market rents. So again, that opportunity to raise rents when people do move out. On the right-hand side, just some pre and post renovation pictures. So just looking at the bathroom, I think you can clearly see, tiling on the wall, new toilet, new hardware, certainly new window dressing. And then in the kitchen, new cabinetry, countertop flooring. I think you would certainly agree, just a much, brighter, more inviting environment.
Yes.
And then just moving on, here's just another example. This particular, building and or unit for that matter is in Moncton, New Brunswick. Here we spent $368,000. As a result, we were able to complete 26 suite renovations, installed again security cameras, lobby renovation, roof repairs, eaves troughs, downspout replacements, corridor renovation. As a result, we were able to raise the rents from $761 to $1,273. We still have, 40% of the existing units under market rent. So again, that opportunity for future growth on the turn. And then again, on the right-hand side, just some pre and post. So kitchen, you can see, new appliances, stainless steel, new cupboards, and then certainly the living space below. So just moving on to, ESG, it's certainly our mission really to deliver, outstanding value to our clients, to our communities, and really to channel all of our experience, expertise, and really assuring that we try to achieve these results really every day. So by reducing costs, we are increasing the potential returns for our investors. So every single renovation benefits from Energy Star appliances, LED lighting, high efficiency boilers, WaterSense toilets, etc. Moving on to the portfolio. So we often get asked, well, what kind of buildings do you buy? What is your ideal building? So here they are. A couple of things I do want to point out, and I guess more importantly, stress, is that we buy value add buildings. These buildings really do have high potential for growth through renovations and really operational improvements. So what do I mean by operational improvements? Not that we don't work with a broker-dealer community, but we do go door knocking. So in some cases, in a lot of cases, We buy off market from mom and pop or small partnerships who've potentially owned the buildings for multiple decades, and they just haven't been run effectively or efficiently. So that's really what I'm referring to when I say operational improvements. So we come in with our active management approach to not only enhance the building's resident experience, but as a result, certainly the property value and then certainly revenue over time. So we are focused in on those secondary markets. So those cities outside of metropolitan areas or our ideal building, sorry, a little tongue-tied there, um, is a walk-up. Generally speaking, no elevators or underground parking. We do have 3 elevators in 3 of the buildings within our portfolio, no underground parking. Why is that important? Well, very simply, less maintenance costs. The buildings that we do buy, have anywhere from 17 to 70 units. And here you can sort of see what they look like. So just going from left to right, St. Catharines, this is a building we closed, late last year, 2024. Purchase price 6.5 million. Average rent average rent $958. And then certainly that very attractive gap to market to raise rents again on the turn when a tenant moves out. Moncton, a building in the middle here, somewhat of a newer build, if you will. This was built early 2000s, 5.75 million purchase price, average rent $1,205. And again, a decent gap to market of 45%. And then certainly, lastly here, as you can see, Hamilton. This was a recent acquisition last couple of weeks. In fact, this and a sister building we closed on. So purchase price here, 6.9 million. In-place rents, $1,100. And again, I come back to that gap to market. Where's the growth coming from? How are we going to generate growth? Well, it's having that attractive gap to market.
And I noticed, Darren, here's a couple buildings on this sheet that are around in Ontario, and I see one building out east. So is that kind of indicative of what you do in your building portfolios? You've got the East Coast as well as sort of in around
Yeah,
Ontario
I
regions.
mean, the mandate for the OM is really across Canada at the moment, and I'll sort of talk a little bit more to that in a upcoming slide. But we have a big focus or growing footprint, certainly in Ontario. We're very, very excited about the prospects in Atlantic Canada, which without question is another key differentiator. So again, we've got that attractive gap to market. We've got that East Coast exposure. And I think, thank you for the question. I think probably most importantly, when we look or when the team looks to buy a building, there's quite a few things that sort of, go into that. We look at current, economic indicators, whether that, be population growth, immigration rates, rental rates, vacancy rates. We certainly want to examine and understand where, governments and consumers are spending money, as an example. So if you look at Moncton, there's a massive Walmart distribution center there. We absolutely see government spending money. Certainly just as important, no surprising, is infrastructure within any city. We want to ensure that there is real connectivity to major other cities. Taking Kitchener in Ontario as an example, there's the LRT within the city. It's home to one of Google's head offices, which is well north of 1 million square feet. There's GO train connectivity to other cities, certainly within the greater GTA. And then we want to examine historical trends. Are these cities stable? Are they, boom or bust? So we want to look at that historical rental growth, vacancy rates, historical population growth, etc. And I mean, just to sort of flip it to Atlantic Canada, but this really does hold true to all of the markets we're investing in. These really have been some of the fastest growing cities in Canada for the last 4 or 5 years. So, that's a key, criteria. Our team, it's growing, it's deep bench strength. Our pipeline, if you will, is north of 450 million. It's 2,600 doors across multiple provinces. And our team, literally, writes up anywhere from 1 to 3 deals a week. So we're active. We're certainly looking to grow. But I wanted to share certainly that with you just in terms of some of the things that, sort of go into how we decide or why we decide to add a property and grow that respective footprint.
Very good.
So here's the sister building in Hamilton I had mentioned. So again, very attractive gap to market, 74% in-place rents, relatively low. As an FYI, the average rent across our portfolio as of today is less than $1,300. So again, good potential certainly to raise rents on the turn. Historically, we've had about roughly an organic turn of close to 20% per annum, just to sort of give you an idea. A building we actually just closed on, was it this week or late last week? But in Waterloo. So really excited about this addition. This is actually our tallest building. This one is eight stories. This one does have an elevator. As I mentioned, there's a couple that do. This is one of them. So again, look at that attractive gap to market, a real opportunity to certainly grow that asset and ultimately, have the investor benefit. And then lastly, this is the building we are closing on today. This one is in Kitchener, $6.5 million. Average rent, as you can see, $1,100 and change, and another, attractive gap to market of 60%.
Very nice.
Just in terms of, a snapshot of the portfolio, again, that asterisk denotes the property closing today. So 31 total properties across 10 communities, 3 provinces. So just to draw your attention to the right bottom portion of the page, this is our Ontario footprint. So, it is growing, certainly across the Kitchener, Guelph, London, St. Catherine, Cambridge, Hamilton, Waterloo area. And then, as mentioned, we're very bullish, excited. Another key differentiator for us is that, increasing growing footprint, if you will, certainly in Atlantic Canada. So Moncton, Halifax, and Bedford.
Darren, just a quick comment. Why out east? Does somebody
Yeah,
live
I
out
mean,
there? Does the family live there? They have a cot. What's the connection?
well, it's beautiful, isn't it? No, but certainly, it's a growing, stable market where ultimately people, want to live. And as I mentioned, I don't have the stats here, but Halifax, Moncton, they really have been some of the fastest growing cities across Canada, certainly over the last 4 or 5 years. So, I mean, that is a big reason. Certainly, there are some favorable landlord regulations, so
I
there are
was
no
going to say,
rent
do they have rent
controls in
control there?
Moncton. Yeah, there's a 5% allowable increase in Halifax every
Oh,
year on rents, which is a little
wow.
bit different than Ontario, which is generally 1+%. Um, but most of all, as I sort of alluded to before, when we identify and really sort of select an investment target, if you will, those current economic trends, where do people want to live? Where is money being spent? And, just to bring it back to your question, sort of top of the list over the last 4 or 5 years is Atlantic Canada. And as a result, we've really been fortunate to pick up some great deals, and we couldn't be more excited to sort of lead with that as a key differentiator and just, be able to grow the portfolio quite nicely as a result.
Okay.
So just moving on here, portfolio summary. So just to draw your attention to the top left. So 2020 was inception. Again, we closed out the year with 73 units. Fast forward to, again, where we are today, 892 units. So I think, strong, consistent, growth really across units. In terms of AUM growth, if you remember from some of the previous slides, we closed out 2020 at 6.7 million. We'll be just shy of 200 million. So again, really excited about that. And then the bottom left-hand quadrant, portfolio gap to market. Again, a key differentiator. How are we going to grow the portfolio? That is the difference between in-place rents and market rents. So currently it's 54.48% as a result of those Hamilton buildings, that Kitchener building, a couple of others. That gap to market is expected to be just shy of 59%, certainly by the end of this month. And then, since we have the majority of our units really in Ontario, no surprise that 74% of the portfolio, from a unit perspective, is top heavy, top weighted, if you will, to that province. And then certainly as a result, the AUM too is more slanted towards Ontario. But I will say again, that whole Atlantic Canada, East Coast is certainly growing. And then just in terms of the offering details, so I'll just draw your attention really to Class A, left-hand side. The key takeaways here are we pay, or historically have paid, an 8% distribution. So that is compounded annually, paid out on a monthly basis. We have a targeted return of 12 to 15%. So last year, Class A returned 11.99%. That's net of fees. Our NAV currently is $10.90. Our minimum investment is $10,000. So we are registered plan eligible across the board. We offer a 2% DRIP discount. And then certainly from a redemption perspective, money is free and clear after 3 years. And then just in terms of, risk factors, I think certainly there are risks really inherent with any investment. We are certainly here to help you, Robert. Happy to jump on a call with any client, make ourselves certainly available for client educational events. But I think most importantly, investors can certainly reach out and certainly benefit from your vast experience and hold their hand and direct them through certainly the private world of equity investing in this case.
Yeah, but it's nice to hear, and you've always offered up your expertise very specific to the company, your marketplace, management. So again, thank you for always making yourself available, Darren.
Well, a pleasure. I mean, that's something that we do take very seriously. We want to make ourselves available. We are a resource. We want to be invested in your business. And we're really excited about the product we offer. And, we're doing something a little bit different than, some of the usual suspects, if, you allow me that expression. So, we're happy to tell the story. And fortunately, we just continue to grow and we've been able to execute. So, we're happy. We're excited.
Yeah. So
So
Darren,
that sort of concludes the presentation.
yeah,
Hopefully I sort of, wanted to keep it, kind of high level, if you will. Maybe a couple of other things I'll share with you. I often get asked, what's the loan to value of
I
the
was just going to ask you that, and
Yeah,
something
so it's
about the
60,
debt. Tell
it's
us about
six,
the debt.
yes, it's 65%.
Okay.
I think, quite frankly, that'll probably ratchet down a little bit as we continue to scale. I think
Mhm.
also something really important to share with you is, our strategy is a little bit different. We go from bridge to CMHC. So Last year, we renegotiated close to $54 million. So last year, the average weighted interest rate in the portfolio was 5.36%. Today, it's 4.06% and trending downwards. So
Wow.
91%, maybe a little bit more, certainly 91% of the portfolio is a mixture of 5 or 10 year CMHC money. So we were significantly able to reduce our debt service, and that's a good thing. Certainly allows us to, buy more buildings at that attractive gap to market. Again, and as I alluded, as interest rates come down and cap rates compress, property values should increase. So one of the reasons why we're super excited about really the prospects for 2025.
That's fantastic reduction. Looks like a 150 basis point reduction.
Yeah, yeah. I mean that is big, and certainly, thankfully we were able to take advantage of that.
Well, that just drops right into the investor's pocket.
Absolutely. Everything we do from the renovations to, reducing our debt is really just zeroed in on ensuring that it benefits the investor, the unit holder.
And it
So
seems like we finally come through that cresting of interest rates and we're on that downward trend, right? And you can see it right there, 150 basis points reduction in interest, which reduces the carrying costs, which increases the value of the REIT. So that's
win-win.
fantastic.
Yeah, win-win for sure. Any other questions? Anything else I can sort of help out with?
Any idea, Darren, on how much fixed interest rate, how much variable? Have you got a lot of variable? I don't know, any quantitative
Oh, well,
metric?
no, most of it is fixed 5 and 10.
Okay,
Um,
good.
I don't know the exact split. Let's go with 50-50. I'm certainly not too far off.
But would you still be buying the new buildings with, is it variable rate mortgages and then you refinance them? How,
Yeah, so generally, yes, we'll go bridge for 18 months and then convert over to CMHC. So that allows us to extract, turn over a few units, take out that equity and then move over to CMHC. Again, whether that be 5 or 10 years, whole factors sort of, go into that analysis.
just maybe just touch base again. Maybe I missed this, but maybe not. Um, what is the due diligence and who's involved with the due diligence when you acquire a building?
So we have an entire team, that does deep analysis. There's a checklist of 50 plus sort of boxes. I mean, we have architects go in, ground technicians before a building or before we put an offer on a building. We know everything about that building from roof to basement. So there are certainly no surprises. Again, we've done all our homework just in terms of general comps in the area, historical trends. It is no small undertaking. I think I alluded to, the team underwrites, 1 to maybe 3 deals a week. Um, so there's a lot of time, effort, and energy that goes into that. So if you just simply do the math, even at one, there's 52 deals. We only acquired 9 buildings. So we turn down a lot of buildings before we actually decide that one is quote unquote of value to add to our portfolio that, certainly, fits the mold in terms of what we're trying to execute and accomplish and most importantly, bring to market to ensure that we can, one, meet that 8% distribution, we can meet that targeted return, and ultimately the investor can benefit.
Other question I have, Darren, is about the overall loan to value and over leveraging. Any comments? who looks at the over leveraging aspect
Yeah, so I
of this
mean, our
portfolio
our
or on an
investment and
individual asset?
finance team do. So as I mentioned, more than 90% of the current debt portfolio really does consist of principal and interest loans, which naturally allows us to reduce that loan to value, which presently is 65% as we pay down that principal. So operationally, the team is diligently monitoring our debt portfolio to ensure that LTV remains within those limits, certainly outlined in that offering memorandum. So it is looked at daily, weekly, certainly reported on weekly. So something we're very cognizant of, and then on a quarterly basis, presented it to the independent board.
I'm going to give you a challenge here, Darren.
Okay.
We've got lots of REITs. There's REITs everywhere. What
Yeah.
makes you guys different? Why do I want to invest with you guys? In in two
Yeah.
sentences or less.
Oh, I might need three. But no, we're really focused on, I think the biggest differences are acquiring value add buildings with strong potential for improvement. So we are focused in on secondary markets, not metropolitan areas. As a result, we are identifying, generally speaking, overlooked properties, and they are overlooked, which is a good thing because in our view, they really do have enhanced value, which we are able to tackle or take advantage of through renovations or strategic upgrades. So, one, different market, secondary markets. We buy a different building. As a result, we have a lot less competition than some of the bigger players who've been around a lot longer. So again, we target that low to mid rise building, again, in these strategic growing markets. Again, that ideal property, 17 to 70 units. We pay more or historically have at 8%, but I think, a very key differentiator and a big, big factor why people should consider us, and I'm not saying us over, but as a complement, as an add-on, is our attractive gap to market. Where is the growth going to come from? It's going to come from a REIT that offers an attractive gap to market, and in our case, 54%. As a result of the recent onboarding of new or acquisitions of buildings, it will be close to 59% at the end of this month. So, if you want to buy an apartment building, why wouldn't you want to buy an apartment building with an attractive gap to market, that difference between in-place rents and market rents? And the proof is in the pudding. Last year we returned double digits.
So I notice the C-suite are a couple of young guys with the stewardship of the father. They got lots of runway to go. They're young. So what are some of their ambitious goals? Again, everybody, forward-looking statement. I'm just curious to see what ambition the young gentlemen have for this
Well,
REIT.
look, we would like to have an AUM of roughly 330 million by the end of the year. Um,
Okay.
we want to have a lot more doors. So we'll see how it goes. I mean, there's certainly no shortage. We're a small company who I think, quite frankly, has scaled quickly. We've added tremendous value, not only in terms of resources, but added, quality buildings to our portfolio. So, I mean, our goal, quite simply, it's not just their goal, I think collectively as a firm, we'd certainly like to hit $1 billion in less than 5 years. And then let's just reevaluate and go from there.
Well,
But wouldn't that be a fun ride?
even if you're what you're talking about, 330 on 190 million is about a 73% growth. And
Which one?
you know what I
Yeah.
mean? Like that's
So some of that's fair market
fantastic
value.
growth.
Yeah, some of that's fair market value. Again, we're buying these attractive buildings with tremendous growth opportunity. And if we execute our strategy, it will be handsomely rewarded, come appraisal time. Appraisals are done on an annual basis. And I think, a great testament to how successful certainly we were last year is that we had a 35-cent NAV increase. We turned over 100 units. We were able to extract, that intrinsic value as a result. And we're gaining further distribution. So we're getting more and more people excited about what we're doing here at Pier 4. More and more people see that, we're doing something a little bit different. And that in turn is, really excited and, allowing us a real opportunity to, I think, tackle those goals of growing to 330 plus million and $1 billion potentially within 5 years.
Fantastic. Great
Yeah.
story. Great start. Um, Starting from those few buildings way back in COVID when everybody was, I don't know about you guys, but I was sitting on the couch. I certainly
Yeah.
wasn't thinking about starting a REIT.
Yeah. I mean, what a great time to start a business. But
5 years is 5 years now, right?
it'd be five years in June.
Look where they've gone.
So the numbers look great. Most importantly, they've been able to execute on their vision, and I think that's only going to get better. We certainly have a lot of the right people in place. We've brought in-house or started in-house and continue to grow, the property management and certainly the renovation aspect of the business. And that makes a world of difference. And, fortunately, there's just a lot of inventory out there. So we'll continue to go door knocking and we seek out some great deals with, again, that attractive gap to market. And again, interest rates are trending down. You really think about, when they started, to your point, they started the business in COVID. Well, that's not easy. And then we had 2+ years of interest rates through the roof. So
Yes.
now that the dust is settling a little bit, I mean, wow, who knows what the next few years might bring.
And last year you had a combined total return, uh, 12%, your bottom end of your target. So now you've had this
Yeah, and
150
that's net of
basis
fees.
point.
So I do want to add that net of fees and a 30.
Yes,
Yeah, so
correct.
we're excited for 2025 for sure.
Well, that's fantastic, Darren. I'm
Thank you.
I'm kind of out of questions. I think you did an excellent job detailing out all the different aspects and specifically if there's anything I take away from this gap to market.
Yeah,
That,
absolutely. Like, I mean, if you think about it as rents, in some cases are softening. If you only have a gap to market of 10% and rents are maybe down 10 or softening 10, 12, 15%, guess what? That's going to
you,
erode your NAV. So having that wide gap to market certainly allows us to weather whatever might be happening in the general sort of, environment, if you will.
well, but no, that's fantastic. And of course, Darren can be contacted here. You have some information at head office. You can reach out to myself, Robert at Robert.Blake at parvisinvest.com. And we're happy to kind of help you, walk you, guide you through the multitude of REITs and zero in specifically on Pier 4 and their attributes. And again, everything's dynamic. So feel free to reach out to hear the latest news, which again, Darren has the latest news. Um, and again, thank you for listening to Darren today from Pier 4. And thank you, Darren, for coming. And we hope to see you all sign up and do some investments. But first, you got to talk to me. Make sure this is suitable for you.
Perfect. Thank you, Robert.
Thank you, Darren.